I'm going to be covering investing in gold ETFs, and I'm going to try and make it as interesting as possible without boring you with minutiae detail. So why don't we kick off? So I have to kick off with the obligatory. We are a regulated investment fund, and this is not personal advice. That's the obligatory compliance, I have to say. So who are we? So VanEck, not many of you would have heard of VanEck, I would presume. We're a relatively new entrant into the Australian market, but we're a global operation. We have our base in the US, we have operations in Europe, and we have obviously Australia and other operations in Singapore. So we're a global, asset manager. But the reason why we're kind of here is laid out here. So we set up VanEck in 1955. I certainly wasn't around then. But we launched in 1968 our International Gold Fund. Now that fund is still operating to this day. So it has been operating since 1968 and is still operated by experienced fund managers in the US. Now in 2006, we launched our first exchange-traded fund, which is an ETF. It was called GDX, and that's trading in the US right now. We launched further junior gold miners ETF in the US in 2008, and in 2013, we launched VanEck in Australia. So GDX, one of the world's biggest gold funds, is now offered in Australia, and it's listed here. We also have NUG. So globally, we manage about $122 billion worth of assets. In Australia, about 13. Now, there's a reason why they've asked us to come and speak today. Yes, we've been running a fund since 1968, but VanEck is considerably bigger in the gold sector than you would probably realise. Here are some of Australian gold mining companies, some of our biggest gold mining companies. Now, this data is taken from Bloomberg. I don't have the share register, but I think it's roughly correct. We are the largest shareholder in Perseus, Ocean Gold, Capricorn, Ramelius, Regis Resources, for example. We're the second largest shareholder in Northern Star, Evolution, some of the biggest gold mining companies. Number 3 in Alkane, De Grey, you name it. Newcrest, being Australia's biggest, we're actually the 5th. So that is just some of the Australian, and that's just a taste of some of the Australian ones. If we want to think globally, these are some of the world's biggest gold mining companies. In fact, they are the world's biggest gold mining companies. Newmont, we're the 4th largest shareholder. Barrick, we're the 2nd largest. This continues on. Goldfields, number 1. If you go to the mid-cap gold companies, which are listed globally, we're nearly the number 1 shareholder in every single one of these gold mining companies. And this is just a taster. You take every major gold company that's producing gold in the world, we are probably one of their top few shareholders. So we have a big involvement in some of these gold mining companies, and we certainly have a vote in all of these gold mining companies. So it's something to bear in mind that VanEck might not be a household name, but in the gold equity industry, we are well known to all the gold mining companies, that's for sure. But what we actually offer and where most of the assets are in this gold ecosystem are in ETFs. Now, an ETF is an exchange-traded fund. That means that the fund trades on the stock exchange. So you can acquire shares in our ETF by going through your normal stockbroker. So the way you might go and buy BHP, or you might go and buy your individual Northern Star resources, for example, however you access that, you can go in and buy an ETF. Now, we provide liquidity. So unlike a normal share, these funds trade at the fair value that that fund is valued at. That means that if the underlying shares are worth $11.05 a share, it's going to be trading around $11.05 per share. Unlike some other asset classes, we don't get significant discounts or premiums to the NAV, which is the underlying value of the company. ETFs have an inbuilt mechanism, and that is they're completely transparent. So everything that we hold in the ETF is made available on our website on a daily basis. So anyone can value them. You could, if you wanted to, you could take our daily holdings file, pull it into your Excel spreadsheet if you want, and pull in the value of it and work out the price of our ETF. It is honestly that simple. And one of the key things is that they're liquid. So by creating the market, we have a market maker on the ASX who puts a bid and an ask on either side, and that means that you can buy and sell an ETF just like a normal share right at its fair value during any of the trading day on the ASX. So that's the benefits of the ETFs. They have some tax advantages, but everyone's tax situations are different. So the key purpose here is that all of this gold money is tied up generally in ETFs. Now, let's talk about the world's biggest gold ETF. It's GDX. We have it listed here, and you can buy it obviously on the ASX. What you get in this one trade of GDX is you get access to 51 different companies, all gold mining companies, by buying one. So you're getting diversification. There's a lot of benefits to actually, buying one individual share, right? If you go and buy one resource company, which will be talking to you today, that's fine. You take that individual risk, and that company might do well, and then you benefit. But actually, it's not diversified. It's not diversifying your portfolio in any way across the gold sector. So by buying something like GDX, there's a list of some of the top holdings, and these are the world's biggest gold companies. What you're getting is access to, Canada, United States, Australia, South Africa, a bit in China, UK and Peru, where the companies are producing gold. So you're diversifying slightly outside of Australia and outside of an individual company by buying the one ETF. So it's just a way to express a view in how you think the gold equities are going to perform. Rather than saying, okay, I think gold equities are going up, I'm going to buy Newcrest. Well, you think gold equities are going up, I should buy GDX because then I'm getting access to 51 different gold mining companies in one. So there is one thing to understand though about GDX, and it's probably the key reason why I'm not up here and I'm going to tell you about individual companies. And that is, GDX is what's called a passive investment. It's index tracking. So this fund in the US has 14 billion or something in it. In Australia, we have about 500 million. It's all the same assets. But it's all, I don't say Northern Star's a great buy, I'm going to buy Northern Star, and I don't want to hold Newcrest. It doesn't work like that. This is an index. So the index says that Newmont is 10% of this index. That means I have to buy 10% of all the assets in Newmont. Then if I take, El Dorado Gold Corp, it's 0.77%. So if I have $1 million, I have to put 0.77% into that. So we are not making individual investment decisions based on the underlying shares that are in the index. And you might say, well, we don't charge much. So compared to an active manager, we charge a fraction of the fee that they would charge for them to go and do all the analysis of all these companies. The irony is it's very, very difficult for the underlying active manager to outperform this. It's been shown that index investments over the longer term will outperform because sometimes active managers have a good year. Oh, I beat the index by 5%, but next year they might underperform by 10%. So by buying the index, you're somewhat mitigating risk, you're getting diversification, but you're not taking company views by saying, oh, I'm not going to buy this company because it's no good. Because sometimes you're wrong. If you think let's take for example something very high level. If you asked me at the start of this year, should I be buying equities? I deal with equities every day. I kind of thought the market was pretty high. And I would have said, maybe think about it, maybe not at this time. There's a lot of risks. Well, the US NASDAQ is up 30% this year, right? It's 30%. The tech companies have continued to go really strong. I'm not saying that's sustainable, but I'm saying if you sat on your hands and thought, oh, I might not do it, then you would have missed out on 30%. So there are key points to being passive in that you just buy the index and you don't have to make underlying decisions based on if you think the company's good. Now, I just need to highlight how big GDX is. GDX in the US, our US equity funds, trades $1.4 billion a day. That's how much people buy and sell of these ETFs in a single day. The whole entire ASX turns over about $7 billion a day. That's every company from Rio Tinto, BHP, right down to the smallest mining company. So these gold mining ETFs turn over about 20% of the whole entire ASX in a single day. So this is how big these mining companies are. And this is why we are one of the top shareholders in every gold mining company in the world. Now, it's not the only way to gain access to gold, mind you. There are two ways. You can buy physical bullion. Now, I know everyone here it's a gold conference, you might go out and buy your physical bullion and put it under the bed. And that's completely reasonable, or you'll store it somewhere and pay insurance. Well, there's a way to do it by buying an ETF, right? So we have a bullion ETF. The other access is through gold mining companies. They're the two best ways to get access to gold. But we have another product, not just gold equities, it's gold. So if you want to buy gold, you can take it, you can put it at home, put it under your bed. If you need to insure it, well, you need to announce that to your insurance company and you got to pay the premium. Or if you don't insure it, then, well, hope you don't get robbed, right? I mean, it's true. So we essentially have a fund that tracks the gold price. It does exactly what the gold price does. So for every dollar this fund takes, we go and buy Perth Mint gold, or we buy gold, and we only buy Australian origin gold. So that is gold that it has only come from Australian companies. So it's been mined in Australia, and it's only from Australian companies. So it's called Australian origin gold. So we're buying this gold, Australian origin gold, and we're buying a higher quality. It's 999, 4 nines. And that's what goes on the shelf. So for every dollar we get in, we go and buy gold. And we store it in the Perth Mint's vaults, which are backed by the WA government. So this is how it works. I was kind of explaining it. You go and buy, NUG is the name of the ETF, N-U-G-G for nugget. You would buy NUG. We receive the money. We go and buy gold from Perth Mint, Australian origin gold bars, store it in their vault. And that vault is insured by the WA government, which is a AAA rated sovereign entity. So if they don't pay up, there's other problems in the country, right? If it was ever gone missing. So it's not insured by an insurance company, it's insured by the WA government. And the one benefit of this particular ETF is that you can actually, because we're holding physical gold bars, you can redeem that for gold bars from the Perth Mint. So you don't have to sell. You can sell the ETF on exchange and cash out, or you can actually send in a form to us and we will arrange for Perth Mint to send you a gold bar equal to the value of your investment. So you can redeem it in physical gold because we're holding the gold on your behalf. So why do people buy gold? I mean, people have been talking a lot today about gold, obviously, and what's going on. But why do people buy gold? Now, this is something you might not have seen before. Unless you're a professional investor, you're probably not thinking about correlations. Now, I'm going to quickly explain that. Something correlates. It's a finance term, and I think it's extremely important for gold. If something is 1, that means it's perfectly positively correlated. So if two assets are 1, that means if one of them goes up by $2, the other asset goes up by $2. It perfectly mirrors it. If something is -1, it means that if something goes up by $2, the other asset goes down by $2, right? So it'd completely offset it. If something is around 0, which gold miners are, and gold bullion, that means they don't correlate to anything. So if you take Australian equities, gold miners correlate here 0.09%. That means that gold mining shares do not move the same as the ASX 200. It doesn't move in any way, shape or form like them. So you think that shares all move the same, but actually they don't, because this is saying that over the long term, compared to international shares, compared to emerging market shares, compared to Australian bonds, it's a little bit higher. In fact, it's showing that gold mining and gold bullion slightly moves similar to bond movement. But actually, in all honesty, gold equities and gold don't move like other asset classes. So they automatically add some form of diversification to your portfolio by holding some. And you will note here that gold miners and gold bullion, if we look at the chart, it's correlated at 0.77. That means that gold miners don't quite move exactly as gold bullion does. And there's a reason. Gold equities, so gold mining companies, are more leveraged to the gold price. Now, I know that's already been brought up today, but that means that if gold price goes up by $5, gold equities will go up by more, right? So you're getting a leveraged effect. As the amount of gold goes up, gold mining goes up further. But it's the reverse. So when gold price falls, gold equities will fall further. So you're getting the good upside, but you're also getting the bad upside. And we've modeled here that the best outcome is to hold a mix of gold bullion and gold equities because you're minimizing the risk. So all this is showing, at the bottom is standard deviation. That just means volatility, how volatile it is. But you're really looking at the return. We've got the return during a bull market from 2016. You can see that gold miners shot the lights out and gold bullion didn't. But in the bear market, from 11 to 15, gold miners were really bad. So if you took out a 50-50 portfolio between equities and bullion, you'd be in a safer place. You'd still get the return of gold with a little bit of upside, but you'd also mitigate the downside which comes from like holding purely gold bullion. Now, I'm just going to quickly jump into an outlook for gold because obviously if we're running so many gold assets, I'll just spend 5 minutes telling you about it. Nobody knows what the gold price is going to do, and I've heard that from a number of people up here today. Anyone who says they know what gold's going to do, they blatantly don't work in the gold industry, I don't think, because you can only make assumptions. You can see here the gold price over the last 2 years has basically averaged about $1,930 an ounce. It's traded in a band, and people have highlighted that today with the 3 tops. I'm not here for charting. It's traded about that level. And it's stayed about that level essentially because of a lot of the risks that have been in society. First, we had COVID, and that obviously pushed the price up. But it held that level because we started getting some systematic problems in the financial system. You've seen stuff in the US where regional banks are starting to struggle. We're starting to get a few cracks there. We had the war in Ukraine and the gas supplies pushing prices up, supply chain issues, suddenly inflation's coming about, interest rates are going up. So that type of macroeconomic environment has sustained the gold price at its current level. Will it stay there? I don't know. But if macroeconomic conditions are still where they are, then there's still a risk of inflation. A recession. We could have a recession in the US. There could be a recession in Australia. Any of those things help sustain a high gold price. If everything become rosy again and everyone was happy, and then the gold price could pull back. But at the moment, I think most people agree, the risk is on the side of there being continued issues in the global economic world order. So there's something to understand, and this is just a ratio. So GDX is the index, or the fund that I told you about, the ETF, it tracks an index. So we have done a really simple ratio. GDX to the gold price and looking at where that was over the time. So the dark blue line highlights the ratio of GDX to the gold price and the light blue is the gold price. So what it's saying is since 2005 or 6 when we launched GDX, for most of the time, the gold equities were worth about 0.92 of a ratio of the gold price. But at the moment, it's at 0.55. And that kind of indicates that over the long term, gold equities at the moment seem a little bit cheap. They seem a little bit cheap. You can take what you want from this, but it does indicate that over the longer term, where gold price is right now, gold equities should probably be a little higher than where they are. And if we really look at some of the key factors with gold, at the moment, all the major gold miners that we cover, and that's most of the major gold producers on Earth, their average cost to get it out of the ground and get it all into a bar-like state is about $1,300 per ounce. So we're good because we know that the gold price at the moment is over $1,900 per ounce, which really frees up their cash flow. So the gold equity companies at the moment, they've had the same issues that we've all had. Their costs have gone up, their wages have gone up, their insurances have gone up, their cost to do business has gone up. But it's okay for them, by and large. It's just cutting into their margin because if they're still producing around 1,300 and selling for 19, they're good. They've got a lot of free cash flow to play. They can keep the business afloat. They can keep new explorations going. They can also use some of that free cash flow for capital expenditure or paying out dividends. So it really helps some of these companies. Now, I just need to preface, I am not talking about gold exploration companies here. All of these companies that I'm talking about are only the producers that are already producing gold and selling it to the market. They're not the ones exploring. So they're in a good state. There's one other thing that's going on, and I know people have already talked about it today. It's central banks. Central banks last year bought more gold than they have in a very long time. Like, some people are saying it's 13 years. I've seen stats that central banks haven't bought that much gold since the 1960s. Now, I don't know. I don't have the stats and I tried to find them. But either way, last year was an extraordinary year for central banks buying gold bullion. And that certainly has helped sustain the 1900. We're not going to get there this year. Things can change, of course. But I doubt we're going to get anywhere near the amount of gold they bought last year. However, there's lots of talk with the BRIC countries wanting to go into gold-backed currencies, and India always wants to buy, China wants to buy. It's hard to say. So at the moment, though, we're certainly seeing more interest from central banks buying gold, and that's helpful to the gold price. Now, there's one final thing I want to talk about. Anyone who invests in gold, I'm always talking in US dollars. I said, oh, gold price is at 1,900 US dollars. Their all-in costs are $1,300. But actually, we're Australians. We're in Australia. We care about Australian dollars. All right, that's what's important to us, the AUD. What are we going to get in Aussie dollar terms? You would have noticed recently, the gold price hasn't moved much, but the Aussie dollar has fallen quite a bit, which means the price of gold has gone up. So anyone holding gold in Australian dollars suddenly feels wealthier, even though someone holding gold in the US is not much wealthier at all. Right? It's just the falling dollar. So we've done some analysis, and what I talked about before with correlations between how things move, there is no correlation between the Australian dollar and the price of gold to do with the AUD USD. So that means you shouldn't really hedge your gold, because there's no fundamental reason over any length of time for you to be hedging your gold back to USD. Because if you want just pure gold exposure, you would hold it in USD. But of course, we're Aussies, we don't. So you could say at the moment, I just need to add this, you could say at the moment that where we are, you could say, okay, the Aussie dollar's around 64 US cents. I might think it's going back to 75 cents. If you have a view on currency, then you would hedge your gold right now. You would say, right, I hold this gold bar, it's worth 1,900 US dollars. In Aussie dollars, it's 4,000. Doesn't really matter what level it is. But I think that's going to go down to 3,500 because of currency moves. Then you would hedge that. You would say, right, I need to hedge that. That's a short-term view. If you're going to hold gold for the long term, you shouldn't hedge. You just need to hold your gold bars, your gold equities, or your gold bullion ETF, because it's going to move based on the currency, which doesn't correlate to the price of gold. So, I'm going to wind up there. Just a quick few key takeaways. So, we know gold's one of the most traded asset classes in the world, and people obviously favour it for all manner of reasons, which is why you're all here. We're offering two ways to get access to it, straight through the ASX. You can buy the gold equities ETF for diversification, or you can buy gold bullion and get access to the price of gold without actually having to hold the gold itself. The macro environment is still supportive of gold. I think there's lots of factors there that are supporting the price at this point in time. And at the moment, it looks like the underlying equity, actual gold equity positions, some compelling valuations. There's some cost inflations, yes, but they've got some good free cash flow. And it's something worth thinking about for your portfolio. But please, out of everything I'm saying, please diversify and don't just buy 100% gold. I know we're at a gold conference, but the number one advice is to diversify your portfolio and not have it just all in gold. Okay? So thank you very much for your time.